Madhav Dhar is joining us right now. He's with GTI Capital, one of the earliest foreign investors in India, and of course manages money here out of India. Madhav, thanks very much for your time. Great to have you with us here. Great to have you back on the show. Our interactions are turning out to be a bit of a turning point for the markets. I'll tell you why, Madhav. You were on the. Let's just take last month, the month of December. You were on our show on the 8th of December, and you predicted the market would correct. The market went down 7% after that. You were on the 17th of December after that. That was the lowest point, 7,961. And after that, the market went up 6% or so. We're not gone anywhere after that, actually. We're off a little bit from that point. So I'm going to ask you, which way, starting today?
Well, as they say, it's much better to be lucky than smart. So, as you know, the sort of short-term squiggles are hard to predict and not something I focus on. I mean, you can't help thinking about it and reacting to it. But, after the kind of move we have had in the last year and a half and the kind of changes, certainly to the political landscape and to the governance of India, that you'd think that this correction should last longer. I mean, corrections tend to end when one of three things happen. There's enough time in the correction, the size of the correction is big enough, or the act of correcting creates enough fear that you wonder whether it's a correction and not the start of a bear market. So one of those three preconditions have to be there, sometimes all of them, for the correction actually to end. So my own gut feel is that we're not quite there yet. I mean, I think, yes, the chatter has changed a little bit. People are worried about it. Oil was a great positive as it was declining. Suddenly it's become a negative. There's a flurry of articles saying why oil in the 40s is terrible, which to me is rubbish, but it's interesting. It's interesting that the mood has shifted, the analysis has shifted, and, nothing changes people's perception than moving prices. So, the rational analysis gives way to fear induced by moving prices. And that's starting to happen, which is a good sign that the correction is sort of solidly underway. So I don't know. I have a feeling we probably drift. I think the next big event for India is going to be the budget. And to some extent, you're betting on what is contained in that policy statement. And my own feeling is I think it'll be terrific. I don't know why, but I think that there is enough pressure. The mood of the government, the intensity is such that this will be their big economic statement, big economic plan, in a way that the last budget wasn't, which was a big disappointment. So I have a feeling there's a lot of stuff brewing that will see light of day, and that could spark something in the markets again, especially if we correct further from here, which to me seems sort of a little more likely, but I don't know.
I mean, so that's pretty consistent with what you'd said the last time you were on the show on the 17th of December. You had said, and we were already down about 6%, 7% or so back then. And you'd said, well, there is some more pain here, right? But then the market rebounded about 7% from there. From that point on, you're saying, well, you're not sure if, we'll keep going higher. It doesn't quite feel right, Madhav?
It just feels that you need to get a little bit more fear and second guessing back in the market. And given the amount of money that has come in, I think it needs to be shaken up a little bit. But again, as I said, these are harder things to call because you're fussing around with 5 or 6% one way or the other, which is nothing in the grand scheme of things. So, as I've said before, I mean, I remain, steadfastly invested and very fundamentally bullish. anytime the market goes up 60, 70%, mainly on PE expansion and is priced for perfection, you've got to worry about it. And I'm worried about it. But I think the change in India's GDP is going from 5 to 7. It's not going from 5 to 5.5. It's certainly not going from 5.5 to 4. So if you look at the broad parameters that dictate market moves, which are growth, especially in earnings per share, that's why GDP is important, interest rates and inflation, those are the two fundamental axes that everything spins on, and they both are positive or dramatically positive, depending on your point of view. The incremental reform has been, I can't point to a single thing in the last 6 months that's been negative, not one thing. You can quibble about things could have been better, it could have been more decisive, it could be more clear, but the marginal change, which is what markets depend on, has been positive. Now, the change in markets may be ahead of the marginal change in reality, which is what will induce a correction. And once the correction fully runs its course, you go back to marginal change, which is very positive. And now you're seeing some little more decisive, bigger stuff. It's not incremental. A GST fully implemented is not incremental. There's direct benefits transfer, this merger and combination of the subsidy schemes through the DBT is huge. This is not incremental. And, the bunch of things that are underway that are not fully clarified, whether it's land acquisition and so on. So it could all culminate in a very, very powerful policy statement and a very decisive policy statement that will give you the landscape of what this administration intends to do. And if that happens, I think even from, 17, 18 times earnings, the markets will go up. I don't think we can go up as much as we did last year just because our starting positions are very different. But I maintain that the local chemicals in the air are very positive, and the international background is largely extremely positive. And I think that can get misunderstood. Yes, growth is decelerating in Europe and Japan. There's a possibility of recession. So we are not going to get the growth impetus from the rest of the world. That's very clear. But on the other hand, some things that are very important to our input pricing, which is commodities, particularly oil, and the price of credit, which is extremely important to a country that needs to spend $1 trillion in infrastructure, is extremely positive. So I think the global landscape is mixed, largely positive. The domestic landscape is mixed, largely positive. So we've got to bet on that.
Madhav, when you said that the explanation that somehow the fall in oil prices is negative, you said it's rubbish. Then you're basically saying that the 60% collapse in the price of oil is largely all supply-led, right? Unlike 2008-9 when it was concerns about demand, falling demand. This time it's all supply-led. Demand is not a problem, right? You've got to believe that to say, well, $40 price of oil does not mean weak demand.
No, it means weak demand. There's no question. But I'm saying weak demand is already there. The fact that oil is going down is not causing the weak demand. That's a symptom of weak demand. So I think the causality gets confused in the analysis. So the fact that oil is going down is not negative. Oil has gone down because demand is already weak. So that's not a predictive indicator. That's a coincident indicator. So we already know that. We know that demand in China, in Japan, and Europe is weak. The world is slightly weaker from a demand standpoint, which is, roughly half of oil pricing. The biggest factor, the bigger factor, the most dramatic factor is supply and substitution in oil. That is a huge windfall, unambiguous positive. So net, it's an extreme big positive for the world. So I don't think there should be any confusion about that. Now, the fact global growth being
Madhav,
low
I don't think anybody suggested
is not
that
necessarily a good thing.
The collapse in the price of oil is leading to weaker demand.
Global growth.
Yes. No, I agree with all the points you make, but I don't think anybody is claiming that the collapse in the price of oil is causing weak demand, right? As you said, it's a symptom, but the fact is maybe markets are waking up to
I know people aren't saying
weak demand. Take stock markets, for example, around the world, right? They've been euphoric. Most markets were making newer highs. And that in the backdrop of the weak global demand that you yourself alluded to, right? So markets were not pricing in that reality. They're now starting to price that reality in. It's showing up in commodities. Copper, for example, is down about 30% from its 2014 high.
Yes,
oil is down 60, aluminum and other prices. Maybe it'll show up in equities as well. Would you agree?
No. Prashant, I'm not. You and I are on the same page. I'm saying I'm just being precise about the statements. I'm saying world demand being a little weaker is not good for stock markets and not good for India. Within that, commodities collapsing is very good for the world, very good for India. So there are two separate variables that have some linkages. So you can't just keep looking at oil and saying, if oil goes any lower, it's a bad thing. No, if global growth, if demand goes any lower, and that is the entire cause of oil going lower, that's a negative for the world. So maybe we're quibbling too much on it. All I'm saying is oil, all things being the same, oil being down is fantastic. Now, to the extent all things may not be the same, that's a separate issue. So there's no question to me that India is in a growth headwind in the next 2-3 years. Well, not 2-3 years, but certainly in the next year or so, there's a growth headwind. So it'll be harder to get to 6 or 7 or 8%, which I think is entirely possible, than it would otherwise be the case, because big pockets of the world are slumping. Whether they're still slumping 2 years from now, I don't think so, and I doubt it very much. But the commentary is always coincident. The fears are always coincident. There's a human nature to extrapolate an extreme reaction that's going on. I mean, I don't want to pick on specific brokerage firms, but a well-known brokerage firm I had a big argument with 7 years ago said oil was at 140. They said they're going to 300. It was headline news, huge reports. And all the books selling were End of Oil, Twilight in the Desert, and so on. The same firm issued a statement saying that oil is going to 40, headline breaking news. You think anybody takes that seriously? Are you crazy? So I'm just saying, to predict that world has gone X growth and oil is collapsing, it's terrible for the world, that's a coincident statement. Markets tend to discount that. So you and I and everybody else watching has to predict, okay, that's already priced in. What's next?
Yes. Okay, let me put it differently. And of course, nobody takes that brokerage seriously. By the way, it's one of the largest global banks.
It's very easy to
still one of the largest.
present.
Madhav, it's the brokerage that you're talking about is still one of the largest. I mean, actually, it is the largest and most powerful global bank, right, in the world. So I'm assuming we don't take it seriously, but a lot of people do take it seriously. Anyway, let me put this argument in a different perspective, which is,
but that's
if you take
fine.
the last bull market,
that's the business they're in.
Yes, if you take the last bull market, 2003 to 2008, oil went from what, $10 to 150, and we had the biggest bull market we've seen. So is there an argument to be made that these are all assets at the end of the day, financial assets, right? There's of course demand and supply, but when it's risk on, as you put it in the past, I mean, it's risk on for most of these asset classes together, right? There's animal spirits are high and people want to make money, and money is flooding all kinds of things.
Yes.
And when that's not the case, then it becomes pretty tough for one asset class to outperform while others are in deep bear territory. How would you respond to that?
No, I think that's a very accurate statement. I tend to agree with that. I think it's very difficult to distinguish yourself. It's very hard to separate yourself from either the global growth cycle, and more importantly, if you're a capital importer like India, to separate yourself from the global investment cycle. No question. You have to do something unusual. China managed to do it over the last 10 odd years. Even longer, where the internal changes in China was so dramatic that its growth was almost entirely delinked with global growth. India has almost never managed to do that, not even in the early 90s. Our growth has been higher, but it's been overlaid on a global cycle, which is very, very normal. So my point is simply that India has had a spread of, roughly 4 percentage points over world, over 2 percentage points over emerging markets, which, by the way, emerging markets are a very loosey-goosey category that keeps changing, so I don't even take that seriously. But let's say there's a global beta factor of growth, and there's an India alpha factor. And it sort of goes in rhythm. So the global growth factor is definitely going to be negative by a percentage point or so, maybe 3/4 of a percentage point, which will affect India. What we have to analyze is there enough going on in India where the alpha factor is going to be above normal. And my own bet is that we are minus 3/4 of a GDP point on global growth, plus 2 percentage points on Indian growth. Net, we should be 1.5 percentage points better than average. That gets me to 7+% growth. I think that's where we are headed. I think, to me, that's still a slightly differential forecast from everybody else who seems to be around 6% growth. So I'm not saying anything dramatic. I'm saying I have enough faith that the alpha creation going on is substantial and will overwhelm to some extent the negative growth beta factor of the world, and there's be incremental growth in India. And if that happens to be the case, and I think February is an important month for that, I think money will get attracted to India. Again, you've had a huge amount of flows, and as U.S. accelerates and money goes back a little bit, you're right, you go into a risk-off phase. But even last year, which may have been an exceptional year, you have other emerging markets which was risk-off, whether it was Russia or Brazil and so on, which not surprisingly are commodity markets, but money flooded into India. So you had a very unusual year where it wasn't a risk-on, risk-off kind of year, which could easily have been, as in previous cycle. So India is showing glimpses of the fact that it can separate itself. And I know I'm betting against history. India has not managed to separate itself. But that's the business we're in. We're in the business of not predicting the present and not predicting the past, but predicting the future and seeing whether it's priced appropriately or not. I'm predicting a slightly better future for India than most people think, and the pricing is sort of okay. It's not great, but it's sort of okay. I think we go up.
In a way, this time it's different, right, Madhav? On a lighter note. Yeah.
Yeah, I think this time is a little different. I think this time is a little different, yes. I think GST is
stay
different
with us.
if it happens. I think if we
stay with us.
Reform this subsidy regime, it's important.
Madhav Dhar is with us, and we've been discussing some of the global trends in oil, commodities. How does India fare when there's general risk off? Madhav believes that we've got a bit of an edge, and he thinks we should be on track to growing at about 7% or so. Many out there believe it will be closer to 6.5%. So Madhav clearly is bullish. Madhav, let's come to the local stuff, right? I mean, you mentioned that you find it very difficult to find anything negative in terms of policies which have been adopted by the new government. I just want to take one, and I don't know if you will say, well, you're nitpicking, but let me give you this one bit of news, which relates to the telecom sector. Now, spectrum auctions are around the corner. And there was a fair bit of news flow which suggested that the government is going to also put for sale the 2100 megahertz band, the 3G band, which was lying with the defense sector. There would be a swap. The government would give some of its spectrum to the defense. The defense would give their spectrum, and it all seemed well and fine. The final offer, which is now out, suggests that only a very small portion of the 2100 megahertz band is being put up for auction. Now, it may seem very small, but we've been discussing this with, industry experts, telecom experts, and they've been saying, all the focus has been on the price of spectrum. It's too high. But the actual issue is the quantum of spectrum which is available. That's the real issue. And if the government doesn't follow what the TRAI is saying, it just sort of it just kills the entire thing. I mean, they have to make available more spectrum out there for sale. How do you react to that?
Well, I think two things. One, you have a point, and they have a point, and two, you're nitpicking. So, no, listen, I think from everything I hear,
I shouldn't have given you that lead.
Things that this is not the best way to go about it. No, it's a fair point. Listen, it's obviously sweeping to say that there's nothing wrong. My point was not that the wonderful things are happening and this year sort of unabashedly embracing every single thing they're doing. My point is just the change at the margin and the focus on almost every single area seems to be positive. I mean, I'm quite disappointed in some of the extent to which they've gone in areas, but as a rational scientist, you have to say the change at the margin in even including Coal India, which I'm extremely critical of, is positive. It's better than it used to be. It's not what it ought to be. The focus on what's happening in railways is better than it used to be. It's not what it ought to be. The GST is better than it used to be, not what it could be. So it depends how you approach these things. And I reflexively think in terms of marginal change. And I think marginal change is broadly positive across almost everything. And perhaps you're giving me an example that could have been better. It's a little messy and small and awkward. Yeah, it possibly be. But this is a large, messy economy, and some of those things will happen. My point is simply that broadly, it's moving in the right direction. It needs to accelerate to separate itself from some of the global headwinds. So let me say one thing, Prashant. We ended the last, time out on this time it's different, which are famous last words, coined originally by John Templeton, that it's never different. Let me just put something in perspective that I'm not sure the viewers really have. India has grown 6.1% real GDP from 1980 to today. 30 years growth rate has been 6% plus. The return on Sensex, Nifty didn't even exist, the return on Sensex in US dollars is close to 11%, annualized for 30%, which makes it in the top 5 markets there have been. So that's the baseline we're dealing with. And I think the perceptions are some Hindu rate of growth and some crazy growth in the global boom cycle, and we're back to our Hindu rate of that sort of stuff. It's simply not true. So your baseline has been 6+% real GDP growth. So when you say that if you believe that there are certain things changing in India at the margin, we're going to go from 6 to 7, that's not a very Herculean jump. So I'm not saying something dramatically is different this time, that the birds will chirp and some magician is going to wave his magic wand and lead us to the promised land. Not at all. I'm saying the country, the electorate is at the point, the mandate is such, the leader is such, the policies seem to be moving in an area where the marginal change is going to be significantly better than we had. And the world is a little more difficult than we had. Net result is I think we'll add 1% GDP point to our trend growth, and I think that will be a positive surprise. That's the statement I'm making, and I think you have to keep perspective that India has had very, very high growth. Not high enough, not like China, not high enough for poverty to completely collapse, not high enough for it to become a middle-income country, but much higher than people realize. And that's what stock market investing is all about, to have a differential view relative to what's priced in.
The 11% annualized market return, is that adjusted for inflation?
It's in dollars, so it's adjusted for dollars, so dollar return.
In dollar, okay, dollar returns. All right, okay, fair enough.
We can have a separate show on that. So comparing like for like.
Yeah. No, so all right, the other big talking point, and I get to the specifics in terms of the budget, right? And this relates a little bit to the budget, actually not a little bit, but to a large degree to the budget, is the changed narrative, which at least I am seeing and hearing out there amongst opinion makers, etc., writers, economists, etc., which is now the fact that the message to the government seems to be, stop obsessing about the fiscal deficit. Right? I mean, same time last year, it was all about the fisc. It has to be lower than last year. The next year number has to be lower than this year, etc. This time, at least industry is asking the government to stop obsessing about that number and maybe spend a little bit more. Market economists, although still seem to be very fixated with why 4.1% has to be met, why fiscal 16 number should be under 4%, etc., etc. And it's an important debate because, I mean, you have a situation where the private sector still isn't spending, and somebody's got to start the cycle, and the government can step in, but it's stopped by markets, financial markets. What do you think? Are we at the cusp of a change in fiscal priorities?
I hope so. I think so. I hope so. Certainly, some of the preconditions are there in the sense that the rupee has been relatively strong compared to its trade-weighted average. So people are giving Indian internal house management a lot of credit. They're certainly giving the RBI head a lot of credit. So we've earned the credibility to spend a little bit. What we spend on, again, I think is important. I think what constitutes a fiscal deficit, its composition is very important. If it is handouts on LPG, kerosene, and farmers, and loan waivers, and NREGA, I think it's terrible. But if it's on infrastructure, on healthcare, on sanitation, on primary education, I think it's terrific. So I think the markets will react not just to the number, but to the composition that goes into that number. So I think both are important. I think, yes, the government can and should spend, but I think it's very important what it spends on. And this is where GST becomes important. This is where DBT becomes important. So they're all linkages that the markets will react to. They will react to the broad thrust of the government, not just a number in isolation. I think the number in isolation is much less meaningful than the composition and the trajectory of what the government is trying to do. I mean, I'll give you another example. I mean, some of these things are very good things that make in India broadly we can argue about, but you can say, hey, it sounds like a nice thing to say. It's probably a good thing if it were to happen. Ease of doing business ranking must go up. It's a very good thing. But that is the end result of a bunch of difficult decisions that gets you to the ease of doing business. So I would like to see in this budget, and I mean, not just the budget, but in terms of regular reform, are we doing the 14 things that takes for India to be better in the ease of doing business? So it's not an end result. Suddenly the rankings won't go up if the roads don't work, ports don't work, railways don't work, the tax regime is not crystal clear. That won't happen. So what the inputs that gets to Make in India, the inputs that gets to ease of doing business, each of those things in great detail must be clarified, how it operates, and the government's view on that should be absolutely clear. That's where we need to get, and I think this year will lead to a lot of clarity, a lot of sense of direction, and maybe a lot is being thrust upon the budget in the next month, but I think that will be the definitive manifesto of this government, and it should have both a very strong ideology, but more importantly, it should have the stepping stones, the detailed stepping stones that are inputs to these obviously desirable and laudable goals of this administration, which is ease of doing business, transparency, anti-corruption, and so on. And a lot of the headlines are like that. I mean, DBT is an anti-corruption device. It's not just a subsidy reform. So it's terrific, but we'd like to see what are you actually going to do on the ground that gets you there?
All right. A two-part question here, Madhav. One, you said 7% growth, right? I mean, that's a couple of years down the line, or are you saying, well, we'll hit that in fiscal 16?
Oh, I'm not sure about fiscal 16. I think 18 months, 24 months. It's hard to predict. I'm just saying that I think that this coming year is going to be a little tough because what we do internally will take time to take hold, and the global economy is moving away from us in terms of lack of demand. So I think 6 is probably a good number for the year, 6 plus maybe, and then 7 plus for the following year. And you and I joked, 6 months ago, I think, inflation goes 9.875 and the economy goes 5.678. So I think that rough trend is probably there, and maybe the global economy revives, maybe Europe cleanses its act, and 18 months from now you may see an accelerating Japan and an accelerating Europe, and India will look very different. So you never want to extrapolate an obvious trend very far.
Right. You said that you hope that they don't focus too much on the fiscal deficit. You said the overall level isn't that important, but how the money is spent. Critics of that, deficit spending argue that it'll affect RBI's response function. Monetary policy will not be eased. Briefly, Madhav, where do you stand on this? at this stage, what do we need? We need lower rates, or we need the government to spend? Or can we have both?
I'm not so sure. No, I think we need the government to not just spend but reform. And I think Dr. Rajan has been absolutely crystal clear on that. And I may be a minority, but I'm a big supporter of what he's done. And I think at some point here he probably should cut rates, because I think the preconditions are being met. And some of those preconditions are that the government does things that lowers systemic inflation. And some of those things are happening in terms of subsidies and so on. But we need to see more action. So I have a feeling that you will get into a perfect storm internally, which is rates will be cut. There will be policies that reduce inflation, reduce corruption, and at the same time, government will start spending without hitting any fiscal cap. So I don't think that is some utopian dream. I think it's eminently possible that what I'm saying is reality over the next 6 months.